There are new 100% write-offs in Trump's big beautiful bill that will save high net worth individuals millions. If you wrote a 6 or 7-figure check to the IRS last year, you're probably staring at a very large tax bill right now, and so this video is for you. There have already been several videos out there on this topic, but most of them are about how to write off a camera or a car. This is not that. In this video, I'm going to show you the few 100% write-offs that actually move the needle when your tax bill is $500,000 or more, when it makes sense to use these write-offs, and when you're better off simply paying the tax and focus on compounding your capital. In one example, we'll take a $1.5 million project a business owner was already planning, and then we'll show you how to legally cut a 7-figure tax bill, which leaves him with more after-tax wealth 10 years from now. If you want to keep more of what you earn, stay with me. Here's what we're going to cover. First, I'll give you a plain English overview of what the new 100% write-offs under Trump's big beautiful bill actually are for someone at the high net worth and ultra high net worth level. Second, we'll look at the big, beautiful levers, 7-figure business investments, major real estate moves, and serious R&D spend. That's research and development spend. Finally, I'll show you how wealthy families are actually using these rules inside of a real estate plan, plus a simple checklist you're going to run through before you do anything. And once we're through this video, you'll know exactly how to take advantage of the new changes of the big, beautiful bill, and when you're better off just paying the tax once again and focus on compounding your after-tax wealth. So let's start with what these rules really are and who they're actually for. Section 1. What are these rules and who are they for? Your CPA will use terms like Section 179, bonus depreciation, or 100% expensing. But in plain language, all of those are just rules that let you write off the full cost of certain business or investment purchases in year one, instead of spreading out that deduction over many years. This video is not for someone trying to write off a $4,000 laptop. This is for you if your annual tax bill is already in the high 6 or 7 figures, or you have a large liquidity event on the horizon, perhaps a business sale, a big stock gain, or a real estate transaction coming up. One more thing. I am not your CPA, and this is not tax advice. My job as CIO at Evergreen Capital is to help families with $5 million or more in investable assets and help them decide which of these tools are actually worth pursuing as part of a long-term wealth plan, and also which of these are just noise and are not going to move the needle for their net worth. That is the lens that I want you to use as we go through this. Section 2, big mover, large business investments in high tax years. A 100% write-off becomes interesting when two things are true at the same time. First, you are already paying a very large tax bill. Second, you are already planning to put real money back into the business. Let's make that concrete. Last year, you wrote a giant check to the IRS for about $900,000. This year, based on your projections, your combined federal and state tax bill will be close to $1.2 million. You own an operating company that keeps growing, and you need to roughly invest $1.5 million over the next 18 months into equipment and facility upgrades, and this is not a nice to have. Without it, you're going to be capacity constrained, and your eventual sale price will suffer. Under the older rules, you would need to deduct that $1.5 million slowly over many years. That's called amortizing it. Under the new 100% expensing rules, if those purchases qualify and they're placed in service that year, you may be able to deduct the full $1.5 million up front. Now, if we assume a simple 40% effective tax rate, that one project can reduce this year's taxable bill by about $600,000. So here's why that matters. You were going to do that project anyways, because it increases the value of your business. The tax rule lowers the after-tax cost and pulls that benefit into a single high tax year. Now let's take it one level deeper. In the no planning scenario, you pay the full $1.2 million tax this year, invest what's left, and your wealth compounds from a smaller base. In the plan case, you legally cut the tax bill by roughly $600,000, keep that cash invested in a tax-efficient portfolio, and then 10 years later, the gap between those two paths can easily be 7 figures. It's going to be several $1 million. The point is not just a smaller check this year. The point is the larger after-tax portion 10 years from now after the compounding has happened. Now, a quick warning. If you spend $150,000 on a luxury SUV, you do not need to just create a deduction. You might save $60,000 in tax, but you still spent close to $90,000 after tax on a depreciating toy. So that's not an investment strategy. We want to invest in projects and assets, even if the tax benefits weren't there. Okay, so before we leave this business example, there's a narrow but very powerful case I want to mention. If you own a manufacturing, processing, or similar business and you are building or buying a true production facility that will operate yourself, your company, there is a new rule that can allow you to deduct a large share of that new building in year one. Think about an owner who's investing $8 million into a production facility or building that's going to qualify for this. If a large portion of that $8 million comes off of your income in a single year, the tax savings are going to be several $1,000,000. That is a narrow use case, and you need a CPA who lives in that world. But for the right owner, it can dramatically change the after-tax cost of facility you were thinking about building anyway. And so the theme is the same: a real project, a real business value aligned with a very high tax benefit. Next, I'm going to show you the real estate side, because for many investors we see, that is where the biggest surprise shows up and the most tax value. Okay, big mover number 2, major real estate improvements and acquisitions. If you own substantial real estate, there are 2 big places the rules matter: large improvements made to properties you already own, and large purchases or acquisitions where you're breaking the building into parts so you can accelerate the pieces that qualify for bonus depreciation. So let's start with improvements. Say you own a commercial building that throws off about $200,000 a year in net rental income. You are planning a $500,000 improvement project. Maybe you're upgrading the parking, you're expanding the project, you're adding square footage, you're doing a ton of interior work to upgrade the building. A lot of that is going to qualify under the new rules. Under the older rules, much of that $500,000 therefore would be depreciated over many years, spread out, amortized. Under the new rules, with the big beautiful bill, a large portion is often written off in year one. It's accelerated, it's pulled forward to year one. So you're going to be able to deduct the full $500,000 against that property, and if it nets $200,000 a year, that one project, the tax benefit is going to offset the income that you're pulling out of that asset. Again, you were going to do this work anyway to protect and grow the value of the building. The new tax rule changes the timing and the after-tax cost of that project and pretty much makes it a no-brainer. Now, the second case, large purchases. If you go out and you buy a $5 million apartment building, let's assume that 20% of that is land, so $4 million is a depreciable building, including the improvements. If you get a cost segregation study, it's a fancy way of just saying a report that breaks out the value components of the building. That report might identify roughly 30% of that $4 million in items that qualify for faster write-offs under the new rules. And 30% of $4 million is $1.2 million. So under the current 100% new expensing rules, that $1.2 million may be deducted in the first year instead of over decades. And for some clients, that is enough to reduce tax on their rental income from that property to close to zero for several years. And oftentimes, they can use it to offset other real estate investments that they have and the profit and capital gains that they've received of those other real estate investments. And so depending on how their overall situation is structured, this can be a giant after-tax benefit that helps people compound their wealth. Now, of course, you should never buy a building just for the tax write-off. It's got to be a great investment. You want to buy assets that you would be buying regardless of the tax benefits. But you now know that you have this giant bonus, this cherry on top tax benefit that's going to enable you to get even higher after-tax returns. And so it's important how you structure the deal. It's important which year you close. You want to line these things up, and you want to think about how you plan other income and gains around this new investment and the tax benefits. All right, so far we've talked about operating businesses and real estate. The third big mover we see is for founders and owners who are investing heavily in product and technology. All right, big mover number 3, meaningful R&D spend. Once again, that's research and development spending. That might be for software, that might be for new technology your business needs. And so if you're spending real money to develop or improve a product, a process, new technology, new software, these rules around research and development change the timing of when you get that deduction. Now let's keep this simple. Say you are planning a $2 million domestic R&D budget next year. This is payroll, testing, development work, everything that supports that initiative. Under old rules, much of that spend would be pushed out into future years. Once again, same concept, amortized. Under the new rules, a large portion can be deducted and pulled forward into year one. On top of that, in some cases, there can even be separate credits based on how the work is structured. So if you're a founder who is taking home 7 figures personally, that timing matters. A $2 million deduction in a year where your tax bill is already very large is going to offset income from the same business and sometimes from other activities that you might have. Again, so we're not telling you to go ahead and increase your R&D spending just for the deduction, and that's a little foolish. But what we are saying is that when you have money that you were already thinking about investing, when you have projects that were already underway, this change in the tax rule is going to be a giant advantage for your business. So how wealthy families actually use these rules? The most successful families we work with follow the same pattern with these 100% write-offs. First, they start with the asset. They start with the investment or project, and then they only pursue the write-offs on projects and purchases they would still have made if the tax law hadn't changed this year. And so real business upgrades, real properties, real R&D. Now second, they pay attention to timing. Big deductions are most valuable in years when the tax bill is already large. That might be a year of a business sale, the year you take a large bonus or distribution, the year you sell a major property in your portfolio. You gotta just make sure the timing lines up. You have to take the tax benefit in the same year you have the tax hit. All right, third, you need to coordinate these moves with an overall tax-aware investment strategy. It's hard to keep track of all of this and still run your business day to day. You want your portfolio to be managed for these taxes. And so you want to be thinking about these things in addition to how your existing portfolio is managed for taxes, how you're handling concentrated stock positions, and how you're generating capital losses over time to offset any profits that might be taken. And so your CPA is there to file your return and apply the rules. Most CPAs are not looking forward, they're not planning, they're looking in reverse and just filing your return. So our role at Evergreen is to actually look at your entire balance sheet, your investment portfolio, your options, and help you decide when and how to use these tools alongside tax-efficient investing so your after-tax wealth grows year in and year out, and not just in one tax season. Okay, before you go out and you chase any 100% write-off, I would encourage you to run through a simple checklist. One, was I already planning to make this investment for a solid and business reason, or am I being lured by the tax benefit? Two, how big is my tax bill this year, and how much will this actually save me in hard dollars? Three, will this spend increase income? Is it going to improve the asset, or will it reduce risk in a meaningful way? Or am I just doing this because I want the deduction? You have to look at yourself in the mirror and be honest with yourself on these points. And four, have I lined this up with another big income or sale event in the next 1 to 3 years? And last five, have both my CPA and somebody who understands my entire balance sheet looked at this together. If you cannot answer yes to those questions, the safest move is often to ignore the noise, pay the tax, and just focus on owning great assets and compounding after tax returns. But if your tax bill is already very large, or if you have a significant sale on the horizon, and you want help building a plan around your business, your real estate, and your investments so that all this works together, you can use the link in the description to apply to work with Evergreen. I'm Brad Johnson from Evergreen Capital. Thanks for watching.